Next, we'll see the 14 marks question. Problem number 16. During the year ended 31st March 2019, Mr. John, resident, sold the following assets: agriculture land in Mysore, urban city, purchased in 99 2000 for rupees 20,000. So, any agriculture land which has been situated in the urban area, it will be considered as a capital asset, but any agriculture land which has been situated in the rural area, it will not be considered as capital asset as per the section 2 of 14. So, if any agriculture land which has been situated in the rural area and if it is sold and that asset will not be treated as capital asset, it has to be situated in the urban city only. FMV on 1/4/2001, that is base year, CII 100 rupees being rupees 30,000 and it has been sold for 5,60,000. Second asset, machinery purchased on 1/5/2018 rupees 25,000. See, any machinery or any furniture, if it is a depreciation, it will be called as depreciable assets. But if you observe in the second asset as well as the third asset, they have not given the value called as written down value, because the asset has been purchased in the middle of the previous year, because the previous year starts by 1/4/2018, but this both the asset has been purchased on the date called as 1/5/2018. So there will be no any written down value for the machinery as well as the furniture, because it has been purchased in the middle of the previous year. So the cost of acquisition will be the purchase price will be taken as cost of acquisition. Only if the asset has been purchased before 1/4/2018 and if it is a depreciable asset, then they will give the written down value and that written down value will be taken as a cost of acquisition. But if in case any depreciable asset which has been purchased in the middle of the previous year, there will be no value called as written down value and we need not to take the written down value, take the cost of acquisition or the purchase price will be the cost of acquisition. So it has been sold for 30,000 and furniture has been sold for 3,800. Next, if you observe the fourth asset, machinery purchase. So even the machinery is the depreciable asset. In 1314, CII 220, that is for the financial year 13 and 14, the CII value is 220 rupees for rupees 50,000. Written down value on 1/4/2018 is rupees 35,000 and it has been sold for 60,000. Next, shop purchased in 2006 and 7, CII value is 122 for rupees 50,000. Sale proceeds is 4,50,000. Last asset, one residential house purchased in 8-9 financial year where the CII value is 137 costing rupees 60,000 and the sale proceed is 5,80,000. During the year, he brought another house for his residence for the rupees 2 lakhs. The CII for 1819 is 280. Find the total amount of capital gain. It's the problem. So let's move on to solution. Assessee, Mr. John, status resident, previous year 1819, assessment 1920. So first, write on the heading, calculation of taxable income from capital gain. So first take the first asset. The first asset is agricultural land which has been situated in the urban area. So it will be considered as capital asset. So asset agricultural land. Now calculate the period of holding. So the period of holding will be from the purchase date and the sale date. So the asset has been purchased on the year that is 99 2000 and it has been sold in the previous year, 31st March 2019. So take the date 99 2000 to 31st March 2019 is the period of holding. Since the agricultural land will fall in the fourth category as it is an immovable property and it should be used for more than 2 years for the long-term capital asset, and if it is used for less than 2 years, it will be called as short-term capital asset. Since it has been used for more than 2 years, it will be called as long-term capital asset. Okay. Next, calculate the income from agricultural land. So first take the value gross sale consideration. So gross sale consideration of agricultural land is rupees 5,60,000. So take the value 5,60,000. Next, from that minus the realization expenses. So in the problem, there is no any realization expenses they have given. So take the realization expenses as nil, and after minusing the realization expenses, we'll get the value called as net sale consideration, that is rupees 5,60,000. Next, from the net sale consideration, minus the index cost of acquisition because the asset is long-term capital asset. So the formula for calculating index cost of acquisition is cost of acquisition divided by CII of purchase year into CII of transfer year. So first calculate the cost of acquisition. So since the asset has been purchased before the base year, that is 1/4/2001, so the cost of acquisition will be the purchase price or FMV as on 1/4/2001, whichever is highest will be taken as cost of acquisition. So check the value. The purchase price is for rupees 20,000 and the fair market value as on 1/4/2001 is 30,000. Correct? So take the value 20,000 or 30,000, whichever is highest, will be the cost of acquisition. So the highest value is 30,000 divided by CII of purchase year, since the asset has been purchased before 1/4/2001. So always the CI value will be taken as 100 rupees into, and the asset has been sold in the previous year 18 and 19. So the CI value the previous year is 280. Now calculate the value called as index cost of acquisition. So we'll get the value 84,000. That is the index cost of acquisition. Next, check it out. Any improvement has been made in the problem for the asset. In the problem, they are not given any additions information. So the cost of improvement will be taken as nil. So the balance amount will be 4,76,000 will be the gross capital gain. Now, from the gross capital gain, claim the exemption, if any, but in the problem, they are not purchased any additional or any new agriculture land. So there is no any exemption for this. So exemption will be taken as nil. So the income from long-term capital gain is 4 lakh 76,000. So next we'll go with the second asset. So second asset is machinery purchased. So take the value, take the asset as machinery. Asset, machinery, and machinery is a depreciable asset, and always it will be treated as short-term capital asset. Okay, but here they are not given the return on value, so just take the period of holding from the date purchased and from the date sold. So date of purchase is 1/5/2018 and it has been sold in the 31st March 2019. 1/5/2018 to 31st March 2019. And since it has been used in less than 1 year or less than 2 years and less than 3 years, so it will be called as short-term capital asset. It will be considered as the other assets. I'm repeating, machinery or furniture is a depreciable asset, and always the depreciable asset will be treated as short-term capital asset. And here the asset has been purchased in the middle of the year, so we have taken the period of holding, and it has been used for less than 3 years category, so it will be treated as short-term capital asset because they are not given the return on value. So we need to take the cost of acquisition as a purchase price and we need to calculate. So first take the gross sale consideration. The gross sale consideration of the machinery is rupees 30,000. So take the machinery value is rupees 30,000. From that, minus any realization expenses. There is no any realization expenses. So the balance will be the net sale consideration is rupees 30,000. Now from that, minus the cost of acquisition. Because since the asset is short-term capital asset, so the cost of acquisition will be taken. And the asset has been purchased after 1/4/2001, so the purchase price will be taken as cost of acquisition. So the purchase price of the machinery is rupees 25,000. So take the cost of acquisition value is 25,000 and check it out any additions they have given. No additions, so the balance amount will be 5,000 and this will be the gross capital gain. And from the gross capital gain, check it out any exemptions can be claimed since the asset is a short-term capital asset and there is no any information regarding the exemption. So the exemption will be taken as nil. The balance, that is 5,000, will be taxable short-term income. Next, we'll go with the third asset, that is furniture. Even it has been purchased in the middle of the previous year, so it will be treated as short-term capital asset. Short-term capital asset. To calculate the income, so first take the gross sale consideration. Gross sale consideration amount is rupees. Check the value. The furniture has been sold for rupees 3,800 and the purchase price is 2,500. Take the value 3,800. No realization expenses. So nil. Next balance that 3,800 will be the net sale consideration, and since it is a short-term capital asset minus the cost of acquisition, so it has been purchased after 1/4/2001. So the purchase price will be the cost of acquisition. So cost of acquisition is rupees 2,500, and there is no any additions information. The cost of increment will be taken as nil, and the balance amount rupees 1,300 will be the gross capital gain, and from that claim any exemption if it is available. So no information regarding the exemption. So taxable short-term income is 1,300. Next, we'll go with the fourth type of asset. The fourth asset is machinery. Okay, and since the machinery has been purchased in the year, that is 13-14, not in the previous year. So machinery is a depreciable asset. So always it will be taken as short-term capital asset. I'm repeating, any asset, especially for the depreciable asset, which has been purchased in the middle of the previous year. So we need to calculate the period of holding, and always it will be a short-term capital asset. But the changes is, instead of return on value, we are going to take the cost of acquisition. But if any depreciable asset purchased before the previous year, then always it will be treated as short-term capital asset, and instead of cost of acquisition, we need to take the return on value as on beginning of the previous year. Okay, next, calculate the income. The gross sale consideration of the machinery is rupees 60,000, which has been given in the problem. See the value. So the asset has been sold for rupees 60,000, and the return on value is rupees 35,000. We need not to take the cost of acquisition, since the machinery is a depreciable asset. We need to take the return on value as a cost of acquisition. Okay. $60,000. From that, any realization expenses minus no realization expenses. The balance is net sale consideration 60,000 rupees. From that, cost of acquisition. So here the cost of acquisition will be replaced by the written down value as on 1/4/2018, because the machinery is a depreciable asset. So always it will be treated as short-term capital asset, and instead of cost of acquisition, we need to take the written down value as on 1/4/2001, because this asset has not been purchased in the middle of the previous year. So take the written down value which has been given in the problem, rupees 35,000. Next, check any additions. So there is no any additions. The cost of increment will be nil. So the balance amount is rupees 25,000. So from that 25,000, that is gross capital gain, claim any exemptions are available. So no exemptions can be claimed because no information availability. The balance will be 25,000. So this will be called as taxable short-term income. Taxable short-term capital gain or taxable short-term income. Next, we have the fifth asset called as shop. Calculate the period of holding. So check the purchase date, check the sale date. So the asset has been purchased in the financial year 2006 and 7 for rupees 50,000, and it has been sold in the 31st March 2019. So 6 and 7 purchase date, 31st March will be the sale date. 6 and 7 to 31st March 2019. Since the shop is an immovable property, so it will be fall in the fourth category called as unlisted shares, land or building. So the conditions is, if it is used for more than 2 years, it will be called as long-term capital asset. If it is used for less than 2 years, it will be called as short-term capital asset. So since the asset has been used for more than 2 years, so it will be the long-term capital asset. Okay. Next, calculate the gross sale consideration. The gross sale consideration is rupees 4,50,000. From that, minus the realization expenses. There is no realization expenses. It will be taken as nil. The balance amount 4,50,000 is the net sale consideration. So, since it is a long-term capital asset, find the index cost of acquisition. So, index cost of acquisition formula, cost of acquisition divided by CII of purchase year into CII of transfer year. So since the asset has been purchased on 6 and 7 financial year, that is after 1/4/2001, so the purchase price will be taken as cost of acquisition. So the purchase price is rupees 50,000. You can check in the problem. The purchase price of the shop is rupees 50,000, and it has been purchased after 1/4/2001. So the purchase price will be the cost of acquisition, and the CA value on the purchase date is 122 rupees. So cost of acquisition is 50,000 divided by 122 rupees purchase price CA value into sale CA value is 2 rupees. So calculate the index cost of acquisition, and we get the value for as 1,14,754 rupees. It will be the index cost of acquisition. And from that, check it out. Any additions, no additions information, so it will be nil, that is index cost of implement, and calculate the balance amount. The balance amount will be 3,35,246 is gross capital gain. And calculate the exemption amount. So no exemption amount. So the balance will be the 3,35,246 will be the taxable long-term income. And last asset we have, the asset number 6 is residential house property. Okay. Now calculate the period of holding. So period of holding will be purchase date and the sale date. So the asset has been purchased in the financial year 8 and 9 and it has been sold in the previous year 18 and 19. Okay, the date of holding will be 8, 9 to 31st March 2019. So the residential house will fall in the fourth category since it is an immovable property. So it should be used for more than 2 years to call as long-term capital asset, and it should be used for less than 2 years to call as a short-term capital asset. So it has been used for more than 2 years, it will be long-term capital asset. Now calculate the value of capital gain. So first take the value called as gross sale consideration. So the gross sale consideration is 5,80,000. Now from that minus the realization expenses. So the realization expenses is nil and the balance amount 5,80,000 will be the net sale consideration. And after that index cost of acquisition because it's a long-term capital asset. So since it has been purchased after 1/4/2001, that is the financial year 8 and 9, the purchase price will be the cost of acquisition, which is the purchase price of the residential house property, that is 60,000 and this year value is 137. So take the value 60,000 is the cost of acquisition divided by 137 is the CII of purchase year into 280 is the CII of transfer year. And the balance is, the value is 1,22,628 is the index cost of acquisition. From that, claim the index cost of improvement. There is no any improvement, so the balance will be 4,57,372 is the gross capital gain. And check it out, any exemptions can be claimed. So if we check the problem, so here during the year we bought another house for his residence for rupees 2 lakhs. So the assessee has purchased the new residential house property. So the exemptions can be claimed by the assessee as per the section 54 because he is selling the asset called as residential house property and it is a long-term capital asset, and after selling that within the 2 years from the date of transfer is purchasing the new residential house property, so is eligible to claim the exemption under section 54. Okay, the exemption amount, that is exemption under section 54 rupees 2 lakhs is the exemption amount because the exemption amount is gross capital gain, gross capital gain or cost of new asset plus amount deposited in capital gain account scheme is the exemption amount. So the gross capital gain is 4,57,372 or cost of new asset is 2 lakh rupees and they have not given any amount deposited in the capital gain scheme. So here whichever is less value will be taken as exemption amount. So 2 lakh rupees is the lesser value. So that will be the exemption amount under section 54. So the balance amount is rupees 2,57,372 is the taxable long-term income.